Hi, I'm Mark Braund. I'm the chairman. I am looking at my colleagues to join us any second. Shaun Doak, Andrea Pankhurst. I'm going to let Shaun take the lead.
Yeah, thanks, Mark. I guess we'll start with quick intros. Andrea, you can go first.
Okay, thank you. So I'm Andrea Pankhurst. I'm a chartered accountant. I originally qualified with one of the large firms. I've been with REAT since the beginning of 2019. And my career history up until now has been very much in the SME sector, focusing on systems and control, improvements, and hopefully making businesses more efficient and more transparent in their reporting.
Thanks, Andrea. So I'm Shaun Doak. I'm the chief exec. I joined the business back in March 2019. I've got a track record of working for blue chips in the specialist cleaning, FM and the HVAC sectors. My background is sales, and I've got a business management degree, so I'm very much kind of hands-on with the sales and marketing side and building out the operation on the health and safety function. Over to you, Mark.
Thank you. I'll be very brief. I'm the chair. I got involved with this company just over 4 years ago when it was very small and in a lot of trouble. I was instrumental in hiring Shaun and Andrea, who've done basically all the heavy lifting. They've done the hard work to get the business to where it is right now. And hopefully we'll tell you about our latest period on the next few slides. So back to you, Shaun.
Yeah, thanks, Mark. So just moving on, please. Okay, so I'll give you an overview of where we are and what we do here at the REAT group. So in essence, the business is split into two parts. We've got the regular daily cleaning, that's one element, and the second part is the emergency cleaning. So reactive maintenance, which I'll touch on a little bit, and some ad hoc work. So we've got three businesses sat within the group. The first one is our recent acquisition, which we completed just over a year ago, of Ladders Free. So they're the leader in the commercial window and cladding cleaning space here in the UK. Typically, the work that is carried out is on a commitment from the customer from 12 to 36 months. 100% of that business is what we call contract maintenance. So it's reoccurring in revenue. Which is very much aligned to the strategy that we set out when we all got involved in the business back in 2019. And they operate nationwide and in Ireland. Fantastic business. It's been a great acquisition. The integration's gone incredibly well. Next, we got Fidelis, which was our maiden acquisition, which we completed just over 2 years ago. 85% of that business is, again, recurring revenue, so similar to Ladders Free. We're on site all year round doing the daily cleaning, and the typical kind of commitment from the customer is anything from 3 through to 7 years. 15% of that work that comes, or the revenue that comes out of the Fidelis business, is either your reactive contract. So it's when we are working against a schedule of rates. So we're typically one of one as a provider. But it could be, carrying out a spillage on a carpet or a high-level clean of some balustrades or something like that. We're working to a schedule of rates. And then last but not least, we've got the REAT Specialist Cleaning, which, as the name suggests, was set up to deal with the emergency and the reactive decontaminations. About 46% of that business, just for your sake, is contract maintenance. So we've got a number of service stations in the southwest of England where we're doing the daily cleans. We've got a number of contracts within the rail where we're doing the what they call periodic heavy cleans. So it's a deep clean of the internal and the external carriages, both on a daytime and an evening. And then we've got some prestigious healthcare NHS sites dotted around London and around the M25 corridor. So that's the business is in essence. Just on the reactive side, we've also got contract, reactive, and ad hoc, which I'll cover a little bit later. So in essence, as I said earlier, our strategy has been focused on building out a long-term contracted business, both organically and through the M&A. We've proven that we've done 2 very good pieces of M&A. The businesses are very, very good and very stable and are moving in the right trajectory, which is brilliant. We've grown quite aggressively organically year on year. We've never had a year where we've fallen below 17% organic growth. The industry or the specialist market that we operate in is large, it's highly fragmented, but we're capable of delivering anywhere in the UK, sometimes within 2 to 4 hours. And I think it's important to stress that there's a lot of players within this market, it's a large market, but there's no one like us who can do anything to do with cleaning. There's a lot of players in the market, smaller businesses who might just concentrate on, oil spillage decontaminations, or they might just concentrate on high-level decontaminations. Whereas anything cleaning, we can do it, whether it's daily cleans or anything emergency. So that basically underpins, our strategy. We're focused on building a 5-fold increase in value over the next 3 to 5 years. Moving on, please, Hannah. Okay, so just looking at customers, I'll not bore you too much here. We've got just a number of logos there. Some we've worked with for many, many years. Some of them are new logo wins. We've got over 1,000 customers now. We clearly operate within a diverse and resilient range of market sectors, number of blue chips, number of large FM providers. So, and our top 10 equates to less than 44% of our revenue. So I think that's a really key metric just to hammer home there for you guys. And if we move on, please, Hannah. I'm going to pass you over to Andrea. She'll give you an overview of the interim accounts.
Okay, thanks, Shaun. So for our first half of our FY23, we're reporting a really significant uplift in our revenue and our gross profits. So firstly, our revenue, it's up 82% year on year. And that is underpinned by organic growth in all the companies. REAT and Fidelis have both grown significantly year on year. And then the other factor is the acquisition of Ladders Free, which wasn't here this time last year, but is now in these figures. Our gross profit similarly is showing a really impressive uplift from last year. It's up by 113%, and our margin is up 410 basis points. Again, the underlying, there's organic growth in both the existing 2 companies, REACT and Fidelis, and then adding in the Ladders Free into the mix as well has helped boost that figure. Our other achievement that has been a stated aim, which Shaun referred to earlier, is increasing our level of recurring revenue. Our goal was to get it up to 85%, and we've achieved that in this first half. We also have a very strong cash conversion. We are often being paid by our customers before we're paying out to our suppliers, so that's a very good model for our cash flow. And then finally, just to say, on our EBITDA, the increased margin is falling down into our EBITDA, and there's again, it's really increased nearly 5-fold since this time last year. Hannah, could we move on to the next slide, please? Thank you. Okay, so just in terms of the different segments that we measure our performance against, our contract maintenance, there's it's more than doubled since last year. And again, as I referred to, that is partly due to the excellent performance of the 2 existing companies, and then the element of Ladders Free coming on board. As Shaun mentioned, all of the Ladders Free business is contract maintenance in nature. The change in margin is to do with the mix of the 3 companies together now. Ladders Free in particular is a higher margin business than the other two. So the impact of that coming in, as well as a focus on improving our margins within the existing two businesses, has contributed to that increase from 16% to 28%. Secondly, the contract reactive, where we are responding to emergencies very often, and our pricing is within a framework agreement with our customers. This has increased with Fidelis doing more of that contract reactive than they previously did. And again, just general growth across those two companies, REACT and Fidelis. Our margins are slightly lower. That's partly to do with the way we've resourced some of this work, and is going to be one of our focuses coming up to see what we can do to bring that back to higher levels. Finally, our ad hoc. So we've had some good growth here again. I might just ask Shaun to say a bit more about the change in the margin on that type of work.
Yeah, thanks. So the reason that, if you notice, H1 2022 was 38%, so it's gone down. In H1 2022, there was still the tail end of COVID decontaminations, which we've said previous were very, very high margin, just due to the nature of the beast that we had to respond within 2 hours, sometimes even less. So that's partly one of the reasons. The second reason is, as we've said previous, we didn't want to continue building out our operator base because it's difficult having them sat on the bench waiting for that kind of work. So what we did, we've actually just taken stock, kept the operatives in play, but we've built out our subcontractor partnerships, which we set up very, very early on in our tenure here. And we've allowed them to help facilitate that work with use of our own operatives. And also in that mix, we had the large contract win in H1 of £800,000. Some of that was carried out using our subcontract partners as well. It was a larger piece of work. So as you know, larger pieces of work, you tend to have to look at margins. And that's the rationale there behind that.
Thanks, Shaun. So just in summary, really, on the results we've published today, they're demonstrating strong growth that's made up of both organic growth and our M&A since last year. We can demonstrate increased recurring revenues, which are really important to us, higher margins overall, and improvements in our quality of earnings. Could we move on to the next slide? Thanks, Hannah.
Brilliant, thanks, Andrea. So just looking at the group outlook, we've had a very strong start to the year, and that's continued into H2. I touched on it early on in the presentation. The group was awarded a multi-year contract. The value of that was £800,000 a year. It was for a prestigious high street fast food chain, over 350 sites across the UK. And that's just an isolated example of what we can do on the cross-selling. That relationship actually started through Ladders Free, and that contract involved the Ladders Free business, it involved the Fidelis business and the REACT business. It was front of house, deep clean of the floors, the walls, ceiling tiles, and also internal and external glazing, and in some instances also the cladding clean on the external of the buildings. So that's just an example of what we've done well. We had some challenges in Fidelis early on in the year, and that was simply because we've doubled the revenue since we completed the acquisition 2 years ago. You know, the run rate of that business now is around about 9.5, a little bit more. And it was just a bit of an inflection point with growing pains. We got to a point where we needed to refocus and just evolve and tweak the processes and the procedures and put the right control mechanisms in place just to squeeze the lemons a little bit and actually focus on profit. We've had some fantastic wins. I'm not going to go through all of them. Wins both in the education and the NHS trusts. and we've had some really good contract renewals. So really, really strong business. Things are going, firing on all cylinders there, which is brilliant. And Ladders Free, continues to make a material contribution. Fantastic set of people, the right values, the right culture, very much aligned to the rest of the group. Really exciting business. And revenues, profit, and cash conversion have continued strongly since we completed the acquisition. So in essence, the momentum has continued really well into H2, and that underpins our confidence in meeting our market expectations. Just moving on to strategy, please, Hannah. Thank you. So I touched on strategy, I think, early on in the presentation. I've discussed it a few times today, so apologies if I haven't. And that is just to continuously improve the shareholder value. We've ultimately built it on 4 key pillars. The first one is scale through organic growth and selected acquisitions. We've done 2 very successful acquisitions now. I said earlier, we've doubled the revenue at Fidelis. Things have gone incredibly well at Ladders Free. We've grown aggressively year on year. Organically, we've never fallen short of 17% organic growth in a year. The second one is we want to strengthen, and we have strengthened relationships with customers. We've cross-sold. I've just touched on the fast food chain there, just one example of what we can do and what we will continue to do moving forward. We said that we'd focus on markets where we had clear differentiation and access to high margins. There is internally a refocus on margins. We're running around about 27% now across 3 businesses. We believe that we can squeeze the lemons a little bit more just to eke out perhaps 1 or 2%, and that's where our focus is. And we've got the suite of offering across the 3 groups is completely different to what's out there in the market. And the 4th pillar is that we are going to continue strengthening the recurring revenue streams through that incremental long-term contracts. I think we touched on it earlier. We've got a recurring revenue run rate now in excess of 85%. So that was very much a key driver very, very early on in setting out our stall for our strategy. And it gives us a great foundation to continue the growth of the business. So just moving on to shareholders. I'm not going to go through every single one of them individually, but clearly for a company of our size, we've got a very strong and growing shareholder base. They're very supportive. We've got a number of institutions, again, who are very supportive, who now sit below the 3% threshold, but there's more to name that are on that list. And it just gives us confidence in, continuing that growth strategy, really. And then in summary, so look, we're the leading specialist in what is a valuable and highly fragmented market. Like I said earlier, our strategy has been focused on building out long-term recurring revenue streams, focused on the high margins and cash conversion. The Ladders Free acquisition was both transformational and earnings enhancing, and it's made a material contribution to the group's performance. And ultimately, we believe that we're well placed to achieve our 3 to 5 year goal. Continue building out the scale in both enterprise value and earnings, and continue to push the business forward.
Shaun, you started out the presentation by pointing out that your background is in sales. Are there any areas of the business where you need to beef up the sales results?
So we've got a really good sales team in place. We brought in Chris Ryan, who is now commercial manager at Fidelis, around about a year ago, just over a year ago. So that was the first step in professionalising that. Actually, sorry, it's a lie. We actually brought in Sam Haywood to professionalise it. He's now group sales director, and then we brought in Chris. So I think those 2 people in the business helped me deal with the tier 1s and the larger customers, just building that out. And then we've got a very good and talented sales team that sit within those teams. The only avenue that we're looking to increase and improve is actually we're in the process of recruiting a BDM to sit predominantly and solely within the Ladders Free business, just to help push that growth even further.
Okay, thank you. This investor considers the ongoing trend towards home working a potential threat. Do you think with possible closure of office space Do you see it as a serious challenge to future company revenues? And if so, how do you plan to diversify away from office-related business?
Good question, but I actually see the converse now, Hannah. I think people are returning to offices. I'm down in London again today. London's busier than it's ever been, and I lived down here when I was at university. There's clearly a lot of people in the offices. Speaking to our large tier one customers, they're encouraged to be in the office Tuesday through to Thursday, so they're in the office, a large proportion of the week. Mm-hmm. If I'd been asked the question perhaps 2 years ago coming out of COVID, I might have had a different view in it, but not seeing that at all. I think it's completely flipped on its head. There are studies recently that have said that people are more productive being in an office environment than working from home. So there's definitely a refocus, I think.
No, I see footfall around the city. I would concur. With the expected rise in free cash flow and move to profits over the next couple of years, would you be looking to introduce dividends?
That's one for me, I think.
Okay.
Hey, look, we've talked about a fivefold increase in value for shareholders over the next 3 to 5 years. We've already demonstrated massive increase in value for shareholders over the last 4 years. So doing it again, I think we know the formula. There will be some more acquisitions. We've done 2 in 2 years. They've created a tremendous amount of value for customers. So it's inevitable that we will find another one. But what I can promise is that they will always be earnings enhancing. They will always be accretive. And they will always be strategically meaningful to what we're doing in terms of trying to achieve our goal. So certainly there will be some over the next 3 to 5 years, but we're not going to be M&A crazy because we've got a good organic growth strategy. I think that there will be the potential for us to look at dividends as we start to generate cash beyond paying down our final deferred payments to the companies that we bought, the people that we bought companies from. But it really much depends on where we are at that point in time. So there's an option that we know may be valued by some shareholders, but there's also the option to continue to grow apace the capital value of the business, and we've got to balance the two together.
Okay, well, you mentioned M&A yourself there, Mark. There will be other opportunities, one assumes, but in terms of, let's say, the next 12 months, are you currently looking at M&A opportunities, or are you still integrating Ladders Free?
So I think that's a great question. The answer is a bit more complicated. So operationally, the management team is completely focused on driving the organic growth of the business, integrating Ladders Free and the cross-sell and upsell come from it, and also trying to modernize, shall we say, some of the workflows in those businesses. I'm the only one that wastes his time looking at lifting rocks to see if there's anything interesting sat underneath them. And I'll be honest with you, I've only just begun to return to that process because I've been so focused in terms of trying to support the team in what they've been doing with the Ladders Free acquisition. So we've only just started looking, and it's only me. I've got some help from BDO, who helped us find Ladders Free. But there's nothing in the works right this moment in time. And I think we took a long time trying to find Fidelis. Ladders Free was a bit quicker. There is plenty of opportunity out there, but there's also a romantic notion of about what companies are worth during a downtime by some of their founders. So it's about finding the right opportunity. We're not deal hungry. It's right time, right place, and if it works, we'll do it. But right now, there's nothing immediately to hand.
Okay, thank you. If we move back to operational matters, there's a few questions here. Obviously, you've added 2 businesses in the last 2 and a bit years. How far are you down the route of cross-selling?
I think we covered that earlier, and I think
it's a good message, worth reiterating, Shaun.
Yeah, no, without a doubt. So look, the pipeline, I've said this all year, and I sound like a broken record, but the pipeline this year is being healthy and much more healthy than it's ever been in any, the 4.5 years that we've been involved in the business. And, a large proportion of that is from cross-selling. Yeah. We can do, I said it earlier in the presentation, anything to do with cleaning we can do, regardless whether it's, general daily clean or it's a fatality on the rail, we can do it. And I think we are very unique in our offering. We can do it on a nationwide basis. So I think, when we are engaging with the customers, regardless of whether it started with Fidelis or it started with Ladders Free, or conversely the way around, we have a lot to talk about, and the sales team are doing a fantastic job in building out that funnel.
Thank you. How much the specialist cleaning is now subcontracted out, and how have utilization levels of operatives improved year on year, particularly in ad hoc work?
That's a difficult statistic, really, because we've incorporated Ladders Free now, and all that work is done by members who are not employees of the business.
Yeah.
So, with Ladders Free in the mix, it's a significant proportion. So I don't think we've got those figures.
No, we've definitely not drilled down on an actual number. But Andrea's quite right. I mean, on the Ladders Free side of the business, we've got over 300 members. And when I say 300, I don't mean 300, guys in a van. Some of these members have got a fleet of 10 vans with 2 operatives in each van. So they're not mom and pop shops; they are professional, outfits. So it is a tricky one. We'd have to do a little deeper dive to understand what that metric looks like. I think, Mark.
I think it's worth me adding in here that this is very much part and parcel operationally what we're now doing. Now we've got scale. Mm-hmm. We have run the company. If you look back, if anybody wants to look back at the history of the company, 4 years ago the company was a £4 million turnover, £600,000 loss-making enterprise. So we basically converted ourselves into something that was very fit for purpose to go out and redefine the company, redefine its values, sell and make money and generate cash. We've now got, with where we are right now, outlooking, according to our brokers, sort of 20 million of revenue and 2.5 million of profit. We've now got a size and scale of the business where we can afford to make careful investments to allow us to continue that scale. One of those investments is in support of Andrea's team. We have just hired now a financial controller with some great industrial experience. And his job will be to help Andrea and the team start to build out what I would call value metrics, the things that we need to monitor and measure most frequently across the business that will help us eke out the extra half a point or a point of profit on the bottom line. We have ambitions to go from just shy of 10% conversion of revenue to profit to getting closer to 15 or 16%. So it's going to be essential that we look at the things that are represented by the question you just asked, but we're not quite there yet. Very much we've had a fit for purpose organization, lean and mean, genuinely. There's no fat in this business. And if we're going to introduce any additional muscle, it has to be earned and delivered in the right way. And that's what we're doing now.
The progress of margins has been a big message that's come through from this set of results. But what caused gross margins to decline at contract, reactive and ad hoc year on year?
So again, I think I covered it earlier in the presentation. There's a few things in play, Hannah. Like I said, you came out of COVID. We were still doing COVID-19 decons in 2022 and H1. We don't have them anymore. They were very high margin, just due to the nature of the work and how quick we needed to respond. Sometimes we were on site within 1 to 2 hours. You've got the use of subcontract partners in the mix there for the large pieces of work. And the reason that we did that, as I said earlier, was that we didn't want to add a pool of operatives who were just sat there at a cost to us, waiting for this work to come in. Because what you need to remember is that ad hoc, although it's ultimately a very important piece of the puzzle, because it's often the kind of sharp end of the spear, gets us in with customers. We're often reacting to an emergency requirement, so we're there very quickly, we impress. And then from that, our sales and marketing approach is a kind of very consultative approach. So then we'll look at, okay, what else can we do? Can we add in some contract reactive? Can we do some daily clean, so contract maintenance? And there's an isolated case just that comes to mind of one customer, and I need to be careful not to mention them because I'm so used to mentioning them. They're in the rail sector. They started with ad hoc. It was a graffiti clean, some 4.5 years ago. And then that led on to contract reactive. We were doing the fatalities, and then now we're also doing contract maintenance for them as well. So we're doing the whole suite of services.
I'd like to just add something here, because we talk about subcontracting, and people think, okay, you're just subbing out the problem. The expertise that's needed to deal with a number of the things that we deal with as a company sits within the company. What we're doing is getting people with the relevant skills and building out a program of work that will get that work completed. It's not just a matter of saying, here's a problem, go throw it over the fence to somebody to go fix. Mm-hmm. There's a fair degree of expertise and resource that goes into it. And when we look at our margins, it's not the net margin. Sorry, it's not the net gross margin of what was the cost of sales. We actually do add in some of that management expertise that is applied. But what Shaun just said there, I want to reinforce. This is not recurring revenue, but it is so important to building our relationship with customers. The example Shaun's just given you is typical throughout our company, and it allows us to, because of our expertise, to talk with, punch well above our weight, shall we say, like we did during COVID, and engage with companies much higher up the food chain, and as a result benefit from that relationship through selling them our stable of offerings.
Thank you. Can you sketch in a little more detail around the investment required into Ladders Free? Sort of how much and where it'll be targeted?
Again, if you don't mind, I'll take that at the top, because operationally there is work being done right now that Andrea and Shaun will work on. But effectively what you have is a great business, and we express this when we've done previous presentations and broadcasts. We've built a brilliant business started and built by two brothers back in the sort of early 2000s, and they spent 21 years building it up. And the financial model that they had was, 3 million of revenue, generating gross profit margins of 50% and operating profit margins of 40%, with a very, very low working capital. And they basically took a novel proposition to market at the time. It's now fairly ubiquitous, but very novel at the time. And they trained people to use this approach and basically capture customers. As they progressed, it became a very good, solid business. But they didn't have our kind of a capability to take that business and sell it much more broadly. But they continued to grow at a relatively modest level, but it was hugely valuable to them. Anyway, the business started just over 20 years ago. Some of the workflows and processes pretty much that old. It's what I would call an analog process. They're very, very good, by the way. The processes really work well, but when you want something to robust that can scale to 2x, 3x, 4x the size, mm-hmm. It would really cause us some challenges in terms of having to resource up that if we were using paper all the time. So digitization is kind of where we want to go. We wanted to spend time looking at those workflows. So we've got a change management consultant in that we've worked with before, who is helping us make sure that we understand the right pieces that we should digitize. We've also been speaking to the members and to customers and to the people that work in the business about, what would they like to see? And we're now building a picture of how we can actually digitize some of those workflows. We're not at the point yet where we're making the actual investment, but what I would say is that we did exactly the same thing at REACT. And actually, we ended up spending less money on the technology and the resources to run the work process and the workflow than we were previous to making the change. And the investment actually wasn't very high, very little capital investment these days in things like software, because largely you're actually using off-the-shelf products or you're buying in SaaS products. So just to allay any fears, we're not talking about some huge capital outlay on some monolithic computer system. We are looking at something that will either be off-the-shelf applications that we stitch together, or we might, now we've reached the sort of scale that this makes sense, we might look at Microsoft as a platform, moving into Dynamics and Business Central and Power BI to run all the processes across the group. And that will have the added advantage of them being very scalable. As we add other businesses, it's very simple to then move them to that model. The decisions are not made. We're in the middle of working through it. Operationally, Andrea and Shaun and their teams are completely immersed in this to make sure we get it right. But you know, at the end of the day, we want to get it right. We will look before we leap, and the investment will not be some big blot on the balance sheet.
I'm sure investors will be pleased to hear that. A little slightly back to acquisitions again then. Are there any areas in particular that you'd like to target in the cleaning market?
Shaun, I normally answer this, but do you want to? I mean, you know, basically, the focus is recurring revenue and long-term recurring revenue, and businesses that have got, you know, better than average margins for their sector. Yeah. But there's no big hole, is there? It's just about, you know, growing scale, isn't it?
Yeah, very much so.
Okay, about the profile of the business then, as opposed to the substance.
Yeah, and look, you know, we could do something large or we could do something small. I think we're erring towards at the moment doing sort of more modest-sized deals. And if I'm really honest, you know, we think there's an awful long way to go with the model that we've just acquired at Ladders Free. That has got so much potential associated with it. We want to make sure we continue to leverage that, but at the same time, we do want to add some further scale of recurring revenue. So, yeah, you know, our ambitions are relatively modest from the point of view of what we might spend, but extremely important from what it might do for the company.
Okay, perhaps then final one for you, Andrea. When you finished paying for your previous two acquisitions in terms of the deferred consideration, what will underlying cash generation be thereafter?
Yes, so I'll just highlight that in this half year, we've paid out 940,000 towards the deferred consideration. So that's come out of our own cash and borrowing reserves, the existing ones. We haven't taken on any new debt for that. In the next half year, we have a smallish amount to pay out on the Fidelis deal. So our cash position at the end of this year is going to be more positive than it is now. We've got some more payments going out during FY24, and those will end in June 2024. And then I'm foreseeing that, you know, what we're earning in our EBITDA will very closely match what is seen in our movement on our cash balance.
Well, and I'd probably take the moment as well to remind everyone you can see forecasts that we've put into the market on future cash flow as well. Well, that is it for questions. So that just leaves me to thank the three of you for presenting today, our audience for joining us and for their questions, and to say that we look forward to hearing a further update in 6 months' time.
Thank you.
Thank you, Hannah.
Yeah, thank you very much.
Thanks all. Bye-bye.
Take care.
Bye.